All right, let's talk about something that affects pretty much every single one of us. Taxes. Specifically, your 2026 federal income taxes. You know, a massive tax hike was actually scheduled to hit, but things have changed. So in the next few minutes, we're going to break down exactly what these changes mean for you and your wallet.
So just imagine for a second, what would you do if you knew for a fact that your tax bill was about to jump a lot in 2026? Well, for millions of Americans, that wasn't just some hypothetical question. It was a very real and very fast-approaching reality.
I mean, look at this. It's really a tale of two completely different futures. Over on the left, that's the tax sunset scenario we were all barreling towards. The top tax rate would have snapped all the way back up to nearly 40%. And the standard deduction slashed by almost half. Yikes. But on the right, that's our new reality for 2026. And, well, it's a much, much different story.
So let's dig into that first scenario, the one we avoided. What exactly was this tax sunset that had so many financial planners and taxpayers on edge?
Well, here's the deal. The big tax reform law from 2017, the TCJA, had a lot of temporary parts for individuals. Think of it like a bunch of tax rules with a built-in expiration date. So if Congress did nothing, at the end of 2025, poof, we were all facing an automatic and pretty significant tax hike as the system just reverted back to the old, more expensive rules.
But just as we were heading straight for that fiscal cliff, Congress actually managed to step in with a solution.
In July of 2025, a new piece of legislation called the One Big Beautiful Bill Act was passed. Its main job was simple: take on this problem head on. It made most of those individual tax cuts permanent, effectively canceling that tax sunset and creating the whole new tax landscape we're living in now.
Okay, so crisis averted. That's the backstory. But what does this all actually mean for your tax bill in 2026? Let's get into the nitty-gritty. First, we got to cover a quick but really important concept called bracket creep. It sounds weird, but here's what it is. It's when inflation pushes your income up, but your actual buying power doesn't change. Yet that little raise is just enough to bump you into a higher tax bracket. It's basically a stealth tax. And to prevent that, the IRS adjusts all the key numbers for inflation every single year.
And here are those inflation adjustments in action. These are the 7 official federal income tax brackets for 2026, specifically for married couples who file their taxes together. You can see the income ranges for each rate, starting at 10% and going all the way up to 37%. But here's the thing. There is a huge misunderstanding about how these brackets actually work.
So many people think that if you're in, say, the 22% bracket, you pay 22% on all of your income. That is absolutely not how it works. Let's walk through this example of a married couple earning $150,000. First, they subtract that big standard deduction. Then, their remaining income is taxed in chunks. The first little bit gets taxed at 10%, the next chunk at 12%, and only the very last dollars they earn are taxed at that top 22% rate. So what's the result? Their total tax bill is a little over 15 grand, which works out to an effective tax rate of only about 13%. Way, way lower than their top bracket number.
And that standard deduction we just used? Well, for 2026, it's getting a boost to $32,200 for married couples. This is basically the amount of your income that's automatically tax-free if you don't itemize your deductions. That's a $700 increase from 2025, which gives everyone a little more breathing room.
Okay, so beyond the big ticket items like brackets and deductions, there are a few other really key adjustments for 2026 that you're going to want to know about.
For families with kids, the child tax credit is now $2,200 per child. And here's the best part, up to $1,700 of that is refundable. That means you can get that money as a cash refund, even if you owe zero in taxes. The Earned Income Tax Credit, which is a huge benefit for lower and middle income workers, now maxes out at over $8,200 for larger families. And if you're thinking about helping family out, the amount you can give to someone tax-free stays at $19,000 a year.
What about investors? Well, there's great news there too. Long-term capital gains, that's your profit on assets you've held for more than a year, get taxed at much lower rates than your salary. And look at this, for a married couple in 2026, you could have taxable income of almost $99,000 and still pay a 0% tax rate on your investment gains. Zero. Above that, the rates are 15% and then 20% for the highest earners.
The new law also brings a lot of clarity for business owners and high earners. That 20% qualified business income deduction, which is a massive tax break for small businesses and self-employed folks, it's now permanent.
The exemption for the alternative minimum tax has been bumped up, and for estate planning, the amount you can pass on to your heirs tax-free has jumped to an incredible $15 million per person.
So, you step back and look at all of this together. What does it all mean? It's about a lot more than just the numbers for a single year. It's really about one thing: certainty. This quote right here from J.D. Supra just nails it. By making so many of these tax rules permanent, this new law has swapped out years of uncertainty for stability. We're not constantly guessing what the tax code is going to look like in a couple of years. And that certainty, that's everything. It gives you a solid foundation to make smart, long-term decisions about your money, whether you're saving for retirement, trying to grow a business, or planning your legacy.
So, we'll leave you with this thought. The big question is no longer, what if my taxes go way up? Instead, the question is, okay, now that I know the rules of the game, what's my next move? Something to think about. Thanks for tuning in.